This is your 20-minute Annuity Tuesday, and my name is Trent Zimmermann. I've got a background with bachelor's in economics, a master's in finance. I'm a chartered financial consultant and certified life underwriter, and I am the director of annuities here at BGA. And BGA is a life insurance, annuities, disability, and long-term care wholesaler working with independent agents across the country. I've been told I string my name along together a little too much, and so I should enunciate it. And I don't know if I did that today, so it's Trent Zimmermann. Now, we're talking today about the AUM Protection Plan. I talked about it also as the RMD Offset Plan. And before we dive in, I'm going to go from a high level on this, that we have some advisors who run this variations on this strategy based off of the changes in the Secure Act and Secure 2.0 on how they look at annuities and how they affect your required minimum distributions, which caused us to ask the question, is there a way to build into annuities to your plan that not only is helping the client, but is actually making the advisor more money? Because the way these advisors were talking about is it makes their assets under management more secure. They're less at risk from catastrophe, and in in a good case scenario, uh, they're looking at the same amount of income and less downside. But in a best case scenario, they're looking at a much larger pool that is going to be passed down to the kids, and being good stewards of that money, they're more likely to get the kids on as clients. It's a good way to look at it, and so that led us to this question here of the goals. To protect assets under management for the clients so that they never outlive funds, die with a larger portfolio than they started with. These are things that we've talked about buy income and invest the rest, and there being a number to optimize for that. But for the advisor, we're looking at the question as well, if this is their livelihood. And so if we're pulling money out of assets under management, putting it into a commission product, how does that affect their long-term numbers? And so we also want to look at protecting AUM income from catastrophic events, run a system that attracts more clients, increase the long-term income, and that's twofold. One, through exponential portfolio growth, plus the commission that you're getting, and generational wealth transfer and being able to attract the children as clients. So when we're talking about dying with a larger portfolio and this exponential growth of the portfolio size, there's a number. And this is just a snapshot of our uh, our retirement software that we use that shows that when you add an annuity in, there's a number that you annuitize that the client will never outlive their money. We're at a 99% chance of never outliving their money. And if they do, they still can cover their baseline costs. Uh, and the Monte Carlo analysis chance of portfolio depletion is less than 1%. And greater than three-quarters of historical backtest. It also shows that there's a greater portfolio size at the end of their life with an annuity. And there's also Morgan Stanley data to back this up, BlackRock data to back this up, and studies have been run over 20, 30 years that show you have a larger terminal portfolio size if you add an annuity into your strategy for retirement. And if you have joined us previously for any of our buying income sessions, you'll have seen this, that we talk about the research behind it, and there's a lot of Nobel laureates who end up talking about annuities when you're talking about finance. We have Eugene Fama that bubbles are only obvious after the fact. William Sharp, market timing is impossible. Best results come from diversity and dollar cost averaging. Daniel Kahneman and Amos Tversky about disproportionate sense of loss and hope of gain. Paul Samuelson, uh, staying invested leads to the best gains. Robert Schiller, our psychology, leads us to buy high and sell low. And they all talk about annuities as being part of this, that if bubbles are unpredictable, if we have this tendency to buy high and sell low because of our loss aversion and our goal is to stay invested, oftentimes products that force us to stay invested in the market and actually lock up our money can perform better over time. And even if they don't perform better over time, them being in the market, you're taking psychology out of it so that they cannot be their own worst enemy. And then when you are taking income out of the equation, you end up having better results because you can stay invested longer, you can take on more risk. And on that, Harry Markowitz, the creator of modern portfolio theory, has said that it was never intended for individual households. It was intended for large institutions with infinite lifespans. Whoa. So consensus on this, we've talked about this a little bit. Annuities often outperform retail investors because they remove loss aversion and reactivity, take out the psychology piece. We don't promise that though. Like we've talked about many, many times, FIAs have an average return of 6.88%. That's from LIMRA. That's all annuities. That's the good, the bad, the ugly, the volatility controlled, the equities. That's all fixed index annuities. Market is around 10.4%. The real return of individuals is 7.9, but they can often outperform because you're taking a lot of those things out. So locking up can be beneficial for some clients. Buying income allows you to take on more risk and stay invested for longer in the market. And the largest returning product in our financial services is the stock market. Insuring for longevity is not only financially prudent, it actually leads to longevity. People live longer, they have an annuity, they have less stress. And sequence of return risk is greater than we give credit to because downturns are impossible to predict. When we talk about where people are putting their money, Ken Fisher, the guy who says, I hate annuities, and gives you a booklet about how bad annuities are, holds large stakes in annuities and himself owns annuities. Warren Buffett has 2 rows of annuities. It's insane to risk what you have for something you don't need, and now is the right time to take some cream off the top. And we're going to talk about that cream off the top idea as we move forward with this AUM protection plan. And then BlackRock study of psychology investing, stuff we talked about. So we're talking about sequence of return risk. This is the reason you buy income, because you can have one scenario, same returns, just inverted in the 2024, where one scenario, you're out of money at age 79, and the other situation, at age 85, you have $2.4 million. And even when you still have money left in the 1998 to 2024 section, we're looking at a difference of 1.2 to 3.5. Sequence of return is a huge risk that we're not giving enough credit to. And when we look at the volatility drag, losing 15% doesn't mean you need to gain back 15%. And if we're also taking out safe money of 4%, we're looking at taking out near 20%, especially if there's a fee added on and it's a down 15% year. We need to make back 25% on a 15% down year because we're taking out fees and income. That's not including RMDs. That is going to exceed 4% after age 85. So when we're talking about it takes 2 to have a good portfolio, and maybe even 3, throwing in buffered assets that we've talked about before. But with an annuity, if you can guarantee 6 to 12% growth and guaranteed roll up and guarantee 7 to 8.5% income payout, going down to 6.5 if you're under 65, but much more than 4%. That's a good thing to add to your portfolio. So we have this modern retirement theory of taking care of essential needs, having a contingency fund, discretionary spending, and legacy fund, and only funding the next once you've filled up the bucket before. And that goes to Morgan Stanley's study about adding these annuities in. I know we haven't gone into assets under management yet. I need to lay the groundwork that we've talked about with buy income and invest the rest for those who might not have joined us. But we're talking about 19% higher probability of sustained income over a 30-year period, 10% on average having higher terminal wealth. Or sorry, not average. I pulled that from the lowest quartile. The lowest quartile had 10% higher terminal wealth. Sorry, I should have marked that better. Now we get into the AUM protection. In 2024, IRS regulations said that if you have annuitized income, if you buy in annuitized income, That money will not be counted that you put in there as part of your RMD calculation. And the income you're receiving, if it's in qualified funds, uh, will be used to offset the the RMDs. So if you have $100 and you put $20 into an annuitized income, and that's giving you $2 a year, let's say, well, that $2 a year counts towards your RMDs, and that $20 reduces the amount used to calculate the RMDs. You were now calculating off of 80. So we're now looking at some really powerful ways of reducing RMD risk and creating income at the same time and be able to repurpose funds and make sure that you're staying invested longer, like we talked about. And also QLACs have come about. I'm not a big fan of them. I think it locks up too much money with too little growth for too long of a time. But they can be effective for the right people. That you can put 200,000 away until age 85 to produce income, and while it's deferred, we're not calculating it towards RMD. A little different than what we were saying before with the annuitized income because that has to be immediate. If it's deferred, you're not getting that benefit. But QLACs are a way to defer that. And you can buy multiple of these. They just can't be like. So you can't buy 5 at the same date for the same income start time. And if you want to talk QLACs, we can talk about those another time and why and the pros and cons in there. But they do fit into this. So what that means is FIAs become more annuitized over time. So you're going to get more and more offset over time. And SPIAs is immediately annuitized, so you get that offset immediately. A DIA does not work for this, a deferred income annuity. A SPIA is a single premium immediate annuity, FIA fixed index annuity. So this idea that we invest the rest with the income floor secured, the remaining portfolio is truly risk money. We can take on more risk and be invested in that for longer. So we can put higher equity exposure up to 100% for some clients. They can include real estate, REITs, international equities. They can be more growth focused now because we're taking more and more income and putting it and offsetting it. So that 4% safe money that they're pulling out reduced to 3%, reduced to 2%, reduced to 1%, even down to 0%. And the less you need to pull out, the less you need to hedge, and the more risk you can take on. So this RMD problem that people are facing is, let's say they've saved enough, they can easily pull out that 4%. They're really at no risk of running out of money. But now at age 75, they're having to pull out greater than 4%, and they might be forced to liquidate funds in a down year. And if we have on average 2 to 3 down years every decade, well, now if they live to 85, we're looking at 3 times that they're going to have to pull out in a down year. On average, if they live 95, we're looking at 6. What's the hit to their portfolio that we're looking at? So the SPIA solution is taking IRA funds that are and purchasing a SPIA, and the premium exits RMD calculation base, and SPIA payments satisfy the RMDs. So let's look at a quick scenario. If you have $1 million without a SPIA, annual RMD at age 73 is going to be 37,000. If you took 250, put it into SPIA, now we're dropping that RMD amount, and the payments you're going to get are going to be 14 to 16.5. You would buy the highest one, so let's look at 16.5. So now you have an RMD difference that you need to pay out of pocket of $12,000 versus 37. And now we have a greater income base, and that's going to last for life. So we're always going to be offsetting that amount in our RMDs. And that income can be put back into a brokerage account if you don't need it. It can reduce the amount you're pulling out from your qualified funds so it can grow more and you can take on more risk. So now we have the portfolio freedom effect, higher equity allocation, slows the AUM depletion rate, create more alpha. By the time you get your premium back, you're living off alpha in those annuities. And that is going to be seen as a gain, but also the longer you can stay in, you're not forced to sell in down markets, the longer you can reap the benefits and have the reinvestment. And the less you're going to be involved in the bond market. The bond market is still volatile. If you need to sell, we saw recently in 2021, I believe, 2020, that we had a 50% drop in bond prices. It's still volatile. If you need to sell, if you can hold it, great. But if you need to sell because there's an emergency or you have an RMD hit, you could be selling in a massively down market. And if we look at the real returns of the dollar, gold, bills, bonds, stocks are by far the highest. Even though they're the most volatile in the short term, they're the most non-volatile and highest earning over the long term. So that's what we want our clients to be in for longer. And if we can reduce the risk and replace the bonds and bills, the gold with annuities that produce income that offset the need to hedge, we can create a lot more alpha in the stocks and eventually create alpha in the fact that we're exceeding and living on gain on the annuities after you receive your principal back. So who's the ideal client for this? Over 70 with an IRA, large amount of qualified funds. This works with people with small amount. We just have to be different in how we handle it. But they want to conserve their AUM, either for legacy, long-term care, or charitable gifting, if they're looking to offset some taxes elsewhere. Or even, if you're life insurance focused, being able to use that to buy a life insurance and increase some tax-free benefit in their legacy later on. So how do you do it at the end of the day? It's a really hard question. Actually, I'm going to go back to this because I don't have a good answer for you. We have the way several of our advisors do it varies from advisor to advisor. They all kind of run off this central program, the Red Zone Retirement, which we're going to get into. And we've stress tested it and pushed it and see how far we can go with it. But the fact of the matter is we're looking at a lot of variables. We're looking at portfolio size. We're looking at age and payout factor for the individuals. We're looking at RMD and how old they are and what they're going to be taking for their RMD. And we're looking at life expectancy as well. And how long we have to look at for protecting this AUM, and the possibilities of return for the advisor as well. So the red zone retirement as a generality is buy an FIA at 65. By the time you're at 73, the fair market value and cash value is going to be pretty low on it. So it's going to provide a decent amount of RMD offset. Then you're going to systematically de-risk with some MYGAs to make sure you're not entering into the bond market and having to sell low. You're preparing for that with MYGA ladders. MYGAs are the multi-year guarantee annuities, and have liquidity tranches that open up. And then placing that de-risk money into a single premium immediate annuity every 10 years to offset RMDs. So at 75, you buy one. At 85, you buy one. And if you're still alive at 95, you buy one again. And monitoring for any large windfalls in between to deploy some of that de-risk money into SPIAs earlier. And so that way, at 73, you're getting a decent amount of offset. The amounts below 4%. At 75, when it's exceeding 4%, you're getting SPIA to make sure you're offsetting the rest. That also helps with increasing medical costs as you age and inflation, that now we're increasing the income over time. So you're killing two birds with one stone, that you are saying, I'm going to let my portfolio grow larger to offset some long-term care to provide for legacy, and also provide more income to offset inflation and medical expenses. Now, this looks pretty similar to something we talked about before, the risk income style awareness plan, that you provide income protection. Then you have an inflationary hedge of time segmentation and periodic de-risking. You have a risk wrapper. In this case, we're talking about cash accumulation IUL. It can be buffered accounts. It can be structured notes. But actually, the creator of this, who was also a Nobel laureate, and I can't think of his name, and I didn't put it on the slide, talks about cash accumulation, i.e., well, it's the best way to do it. And then total return, a classic portfolio fully invested in equities and REITs, real estate, international equities, and so on. Now, we stress tested this and did a 30% of your portfolio pulled out every time there's an RMD required. So if there's a great year, it might be a 2-year difference. It could not be a 10-year difference. Um, and that was in, best case scenarios that we started deploying these every 2 years. And even then, the AUM and commission combined equaled the lifetime income of the advisor with AUM alone, with less risk and greater upside. So even the most stress tested version protected income for the advisor and protected income for the individual. I don't like doing that of 30% every time RMD is required. I think it's very aggressive. I think it locks up way too much money, and gives less freedom, but it works at the end of the day. So the most stringent version of this still works. So now we get into the QLAC game changer, to add this on, that you can take extra money out at 65 and put that aside and continue to lower that RMD base and still put money into the future. And like I said, you can deploy multiple of these. They just can't be similar. So maybe you have one that deploys at 80 and 83 and 85. You can absolutely do that. And so when you're looking at the tools to use, QLAC is going to be deferred, SPIA is going to be for immediate, and they do largely the same thing. They're going to offset RMD payments with the income and take it out of the RMD calculation. So at the end of the day, we're talking about AUM protection, we're talking about RMD offsets, and how we can increase a portfolio using income and offsetting RMDs. All that being said, if a Roth conversion is better and you're working with somebody young enough to do it who's in the right tax bracket, go for it. If you are looking at all this and saying there's so many ways to skin this cat, pardon the phrase, call me, email me. We can talk through specific plans. But at the end of the day, here's what I want you to take away. If you like this idea and you think this could be a good add to your practice, have annual reviews with your clients. Figure out what their RMDs are going to be in the next year. Go through a systematized way of fact finding. We have fact finders for you. And then you and I can talk and meet and discuss your clients and say, does this fit for their situation? And if so, how can we do this in the smartest way that you're going to be having consistent pipeline of sales for the rest of your client's life that will protect them, provide you more income, and be better for their portfolio at death. So with that, that's your 20 minutes. I know we ran over by 3 minutes. If there's any questions, hang out. We'll chat a little bit more. And next week, oh geez, what are we going to talk about? I did not prepare a poll for this. So if anybody has any ideas, throw them in there. I've got a list of other ideas, and we'll send out an email like I always do on these, and I'll include what we're going to be talking about next week. But if you have any suggestions, let me know. Email me, uh, call me, text me if you have any questions, or if you want the fact finder as well. Thank you all for joining. That's your 20 minutes.